Good. Oh wow, good. I actually have people here. The other one it took a bit. So yeah, I just wanted to basically this is a moment where however you want to ask questions about things, ask questions. If you want to know a concept or a topic, I can work with that. If you just have a problem you want to solve, then I can work with that as well. Um, and what was I going to say? Or, like in the last one, I mean, the few students that showed up, basically they were just working problems, and when they had questions, they were just shooting them at me as they worked through the problem. So it's up to you how you want to do this, but I'm here for you guys however you want to.
Can we go over like the expenses, just kind of everything about the journal entry with expenses?
So do you have like specific expenses in mind at all? Like because so because I'm thinking about like for example, we record some expenses during the period. Like if we paid our employees for work they did this period, we debit wage expense and credit cash. Or are you talking about like expenses we adjusting entry expenses?
Like like adjusting entries.
Gotcha. Cool, cool. Let me look. I will pull up a document for that and give me just one moment. All right, so this is the second chapter problem set material. And um yeah, I'm gonna work a couple of these. And then I might work a couple from a different style of problem. Something like example two and describe my process as I'm going through that. Um, just looking at them and seeing which one of these. Yeah, that's what we'll do.
So for like the exam for chapter two, these are going to be like the kind of questions you're going to ask us.
Correct.
Oh.
Yes, yeah, no, that's a good question. I mean, except that for with the qualification that it would look more like uh like that, maybe that many, or even maybe, that many.
Okay.
So, I'll cut it down a lot. Um, but yeah, so basically, like I wouldn't really ask you ones by themselves. On the exam, I'm much more likely to put it into a format like these. Um, but the ones by themselves help just kind of as a simple example of, how to work through things. So that's why I was looking at these. So let's look at like this one, for example, number two. This is an interest rate calculation problem. And the what's basically going on or what we have to account for is that because this came through on May 1st of this year, that's when we struck the note, borrowed the money or basically didn't borrow money in this case. We actually got an asset, but we told this company, okay, we are indebted to you. We signed a note that says we're going to pay you back in 2 years. So it's on May 1st that the interest starts to accrue. So after May 1st, interest accrues on the note. And that's the adjusting entry that we're chasing here. Um, So anything that has interest that our company owes or is owed, right? Payable or receivable, we have to show that interest as an adjusting entry because interest is usually paid every 6 months or every year or month. It just depends on the payable that we have. But it might be the case that there's some months for which we haven't paid interest yet. And in this case, since we're paying all of that interest way in the future, right? Then we're not going to have a moment where we debit interest expense and credit cash, even though interest expense should be accrued. And I'm kind of going real slow in talking about the concept of why we're doing what we're doing. Does that make sense what I'm saying?
Yes.
Okay, great. So with that in mind, we want to debit interest expense. And if we are recording interest expense but not paying it, then what do we have to credit?
Second 14.
Thank God I can mute people. So make sure you mute yourself if you're going to have a lot of background noise. Anyway, so interest expense, what am I going to credit? If I haven't paid it yet, I haven't actually made the cash payment, but I'm recognizing expense. What do I need to record?
A payable.
Correct, right. So, and that's how I want you to think these things through. Well, I'm recording an expense that needs to be here, but I'm not paying it. So what, oh yeah, okay, so a payable makes sense. Do that rather than react to, words in the problem or stuff like that. Because I find that sometimes, and I don't know if anyone's doing this, or anyone present, I should say, is doing this, but I do know that students will attach to things like, oh, if I see note, I automatically go into interest expense mode. But if I'm lending somebody money, that's still a note, but now I'm receiving interest, not paying interest. So you just got to be a little careful. But we are paying in this case and all that. So now and also I want to emphasize is that if you don't, if that's all you knew, put these down at least. Because when I'm grading, I grade, for example, like, okay, they got the accounts right. That's a certain number of points. Okay, they got the amount right. That's a certain number of points. So, show me everything that you know, just so you can get as many points as you can. So the calculation, we have to figure that we have from May 1st to December 31st. On the exam, all of them are going to be December 31st year ends. So this is, there's some problems that do quarters and things like that. But on the exam, I just tell students, like, look, don't worry. It's always December 31st. It's always an annual adjustment. So between these two dates, how many months are there?
7.
So that's, go ahead.
Oh, I was just counting the months in my head.
Oh, so there's actually one more than 7. There's 8 months.
Oh, you see, I would have got that wrong.
Mhm.
Be careful. So again, show me your works because if you do 7 rather than 8 months, I mean, you didn't do it right, but it's a very small error. So if you show me like you did this whole calculation with 8 months, then maybe point 0.5 or 1 point off. If you don't show me what you did and you just throw down a number, whatever like that, that's 3 points. So, make sure you show me work so I say, oh, they got everything but this one tiny piece, then that's not a big deal. But it is 8 months. I think the best way to consider it is if you're starting at May 1st, 4 months have passed in the year, January, February, March, April. 4 months have passed, so 8 months must still be there. Um, so with those 8 months, that's the amount of interest expense we want. Now, when we take the $250,000, that's the principal, right? The amount that we're going to have to pay. We take that and multiply it by the interest rate. And always understand that that annual interest is assumed unless otherwise said. So unless I tell you this is monthly interest or quarterly or whatever, usually it's either expressed in monthly or yearly interest. But if I don't say anything, always assume it's annual interest. So what that means is, over the course of 1 year, I'm going to generate that much interest expense. And that becomes that calculation nets $20,000. So, but again, I'm labeling it to say interest paid for 1 year. Now we have to, but we're not looking for a year, right? We're looking for 8 months. That's what we really want. And if 20,000 represents a whole year, then we just divide that by 12 to get it into a per month amount. And that is, if I round it, that amount. And then if I get that amount and multiply it by my 8 months, I now have the total amount that I want, which becomes that amount rounded. So this is what I want for my value for the amount that I would debit and credit, because that represents 8 months of interest at a 8% annual rate. Um, so yeah, any questions about that calculation or anything I did there?
Mm-mm.
No, sir.
Awesome. So then we just have to note the effects. What does interest expense affect? Between, when I say effect, I mean like A, L, or NI.
A.
Actually,
No,
net income.
not income.
Yeah. So almost anything that has the name expense, right? And not just those things, but definitely something that says expense, your first thought should be net income, unless otherwise prove it. Like my bias, as soon as I see the word expense, my bias is to say, oh yeah, this is definitely something that's net income. And 99 times out of 100, it will be. How about the interest payable? What does
Liability.
it, liabilities? Yep. And what does it do to liabilities?
It increases.
Good. So then, again, these are just extra points on the exam. Um, that, like another like zero point 0.5 points each or 2.25 points each. But yeah, definitely, make sure you can label all of them. So that's how you do the interest one. Let's look at a couple others.
So the way that you're showing your work right now, is that how you want us to show our work like on the test?
Yeah, I mean, ideally, yes.
Okay.
So yeah, and like in it, and I, I'm pretty sure. I think everyone. Well, I'm not sure about owner, but I'm pretty sure yeah, I know Shelly, you're in my online class. Savannah, you're in my online class too, I imagine.
Yes, sir.
Okay. So yeah, it's a little tough on the online test, and I definitely give you guys more time because of that, because it's much easier to write the math than it is to put it into a dang Word document. But yeah, I would like something like this. I'm also going to let you, and I want to make sure you do both on the first exam, just so I don't miss anything. I'm also going to let you like use scratch paper on the test. And so there's an option I can check, and I checked it during the boot camp assessment. I'm not sure if you took it, where you can basically take a picture of what you've been working on this paper and then show that to me and then it takes a capture of it, and then I can use that as well. So if that works, then I'll probably just go forward telling you just use scratch paper. It's much faster, but input your answers like this into the processor. But the scratch paper, I think will that second method will help a lot. It's a new feature that came with Blackboard Ultra that I haven't tested, but I want to. Um, let's see. Okay, yeah, this one works. This is a little bit of a different one, maybe in terms of the time periods that well, yeah, the time period that it's working with here. Um, so we paid in advance for rent on July 1st. The $100,000 that we paid in advance will cover the company's rental expenditures until May 1st, 20X3. So, and I'm counting on my fingers, even though you can't see me. How many months is this rent contract?
10.
Yep, good. So $100,000 basically bought me 10 months. And you wouldn't have to put this on the exam. I'm just kind of typing out how I come at problems and what I'm the words I'm thinking in my head while I'm doing the problem. Um, And so yeah, then the first thing I'm like, okay, well, I want to figure out the per month amount of this. If it's 10 months, then I take the 100,000, I divide it by the 10 months it represents, and it tells me, okay, I am paying 10,000 per, or basically my rent is 10,000 per month. Now, what is the accounting period that I want to make the adjustment for? What is from what date to what date?
From
Would it be
July to
July?
December.
Yeah,
December?
exactly. Good. Thanks. Yeah, July to December. And just, because, and you might be like, well, how do you get the December date? It's up at the very top where it says make adjusting entries for December 31st. But as I was telling you, it's always going to be a year's adjustment. The fiscal year end for the company will always be December 31st. So if we're going July 1st to December 31st, how many months is that?
Six. Six?
6 months. Yeah. 6 months. Exactly. Because if you consider July 1st, that's exactly halfway through the year. 6 months have passed. June has passed, right? And then we have 6 months remaining. Or just count it out on your fingers and say but make sure you start with, because July 1st, it's all of July, August, September, October, November, December. Good, good. And then so if we want to adjust for 6 months, we take that and multiply it by 10,000. Oops. And then we get 60,000. That's the amount we want to adjust for. What are the accounts we want to adjust?
Oh, three, 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 one.
Prepaid rent, you said? Yeah. So prepaid rent is one. Do I want to debit it or credit it?
We're gonna credit it.
Correct. So it's an asset. Basically, the $100,000 when we paid it created a prepaid rent account for 100,000. But now that 6 months have passed, we're making this record at December 31st. Then we want to, oops, sorry, debit prepaid rent. And I'm sorry, credit. I said debit, but credit prepaid rent. What is the account that we want to debit? Exactly. And since we have an expense here, do we want to, what does that affect? Net income, asset, or liability?
Net income.
Yeah, there you go. Good. And expenses do what to net income?
That's what decreases it.
Right. Yeah, good. And then we credit the asset as well. Assets are used. Great. And now we just have the amount that we have to put in. We drop the 60,000 in there and we're good to go. Let's look at one of these. Now, doing the exact same thing, but just changing the format of the information you're working with. So I'm looking at example two. Yeah, this one's a good one because it has one, semi-easy one. just adjusting for accumulated depreciation, and then it has one where it's not quite as simply put. So for this one, it says the building has no anticipated salvage and an estimated useful life of 20 years. What's the adjusting entry at December 31st, 2020? Determine the date of the building's purchase. So we'll work at maybe talk about that, determine the date thing here in a second. But first, let's do the adjusting entry. So the building cost us $1 million. And depreciation, that's the historical cost of the building. That's what we keep our assets at, is historical cost. So that means I bought it at $1 million when I bought it. Now, when I bought it, I recorded a debit to building for $1 million and a credit for cash. Let's pretend like I bought it cash, $1 million. Now, this journal entry is accrual accounting, but the problem is with accrual accounting, anytime I spend money, anytime I spend cash, that ultimately has to become an expense in order for my accounting system to function appropriately. Um, Now, the only way that that can become that is going to become an expense over time is by recognizing that cost when the thing we spent the money on helps me produce revenue. So,
So like when you sell it.
well, in the case of an asset like the building, right? Usually with something that is a PP&E asset, we want to, we're not trying to sell it. We're actually going to use it, right? In our, like, say, we're purchasing a warehouse to do car repairs from, or we're purchasing a manufacturing plant to, to create inventory in. Sorry, I got distracted for a second. So we want to, if we're going to use this building for 20 years, that's what useful life means, is that we're going to generate revenue by using this in our operations for 20 years. Then we want to split up the $1 million cost over those 20 years to figure out how much per year I really actually want to recognize. And so that tells me I want to recognize $50,000, and we call it depreciation expense. But really, all I'm doing is saying, look, I spent $1 million here. I need to know when to recognize that cost as an expense. I do that as it's generating revenue, and it's generating revenue in its useful life. So the entry to record depreciation expense is what?
Depreciation expense and accumulated depreciation.
Excellent. So we got those going in, and that is always the case for the depreciation expense of any of our PP&E assets. If we if we debit and credit these accounts, how do I classify? What is depreciation expense? What does it affect?
Net income.
Yep. Read decrease. And okay, this one is a little different. What does this do?
Does it decrease the asset?
Yeah, exactly, Crystal.
Okay.
It's a contra asset account. And all that a contra asset means, it's not anything terribly special, but it means that it's attached to a real account. Or I shouldn't say real, because that's a loaded word in terms of other things we do in accounting, but it's attached to, I'll say, a primary account, one that gives it some meaning. In this case, it's the building account that gives it meaning. And so when we see this presentation, I have two ledgers in my book of ledgers. I have a building account and I have an accumulated depreciation account. That's the asset contra asset. All this means is that when I go to report the building on the balance sheet, that I will report the building net of the accumulated depreciation account. So that's the only thing that contra assets do. It's like they record separately in our accounting records, but when we prepare a financial statement, we take the two balances and combine them. And that's
Well,
true.
Where'd you get the 700,000 from?
That excellent. Just one moment. It is the question, or that is just the 1 million. Oops. Minus the 300,000. Because if the 300,000 is a contra asset, that means it's reducing the asset it's tied to.
Oh, I see. You got that from the unadjusted. Okay.
Yeah. Oh, sorry. Yeah. I got it from the unadjusted trial balance, this piece here. Because now, what will these accounts look like? If this is the unadjusted amounts, what would the adjusted amounts be? Because that helps me answer the next this part of the question. Oops. Would the building account change?
No.
No. Would this guy change?
What guy?
Oh, sorry, the accumulated depreciation.
I was like, yeah, it would change to the 300,000.
Right. Well, it's at 300. So now after I
Oh,
make
it'll be at 350.
correct. Yeah, exactly. So my adjusted at that date is going to be at 350. Excellent. That's what I was looking for. And so if accumulated depreciation goes from 300 to 350, what's it going to do to what I express my assets at? Will it still be at 700,000 or what will the new amount be?
650,000.
Exactly. Because now we have the additional adjusted amount on there. So that's why ultimately what it does when I credit this account is it reduces assets more. The other interpretation, or the perhaps the more the quick way of remembering, if it helps, if you need a quicker way to just seal it into your brain, what I tell my students a lot is even though it's a contra asset, it still follows the debit credit rules of assets. So when I credit it, it still follows that rule that credits reduce assets, so they also reduce contra assets. Oh, sorry. Yeah. Yeah, no, that's what I was going to say. All right. Then the next piece talks about like, well, when did we purchase the building? We have two amounts here. This is the unadjusted balance at 12/31/21. Just making no 12/31/20, sorry. I thought it was in 21. And this was the adjusted balance at 12/31/21. Which one is incorporating the information? Not 21, damn it. Which one of these, it's 20. Which one of these is incorporating all of the information from 2020, the unadjusted or the adjusted?
The adjusted.
Exactly. So this is kind of what we want to focus on. And when we're talking about when was the building purchased? So according to our adjusted balance, can we use the accumulated depreciation here to figure out how many years we've been recording depreciation?
Yes.
Right, because if I'm doing it at 50,000 a year, then that means I have done this for 7 years. And if I've recorded, this for 7 years, that means I have 350,000. But if I've done this for 7 years, that means I've had this asset for 7 years, including 2020. So I could just count backwards. That subtraction can be your friend or your enemy. You can subtract in this case, but I would also count backwards just to be sure. You could take 7 and subtract it from 20, and you'll get 1231 20, 1231 13. Yeah, that is correct. You would just have to remember to say, oh yeah, that was still at 1231 because that would have been 7 years ago from this date. But if you count backwards, it works too. You have to say, okay, 1 year to 1231, 19, 18, 17, 16, 15, 14, 13. Okay, yeah. 7 fingers are up. 1231, 2013 is my date that I purchased. So if you were like, oh gosh, okay, that's a lot, I agree. If you can navigate this, you've got like, I would say, an A minus or A understanding of the material. If you can navigate this, then you have an A plus understanding of the material. So we're not talking about, oh, I'm going to fail the test if I don't know how to do this calculation at all in any way, shape, or form. So that's that one. I want to talk about, um, let's see, this guy here. This one, can get a little bit intense for some people. Um, or maybe not this one, actually. This one's not too bad. So it says the prepaid insurance account reflects 18 months of the remaining contract. It was originally paid for in full in 2019. Provide the adjusting entry at 12/31/20. So we took this out in 2019, but what it's telling me here is 24,000 is 18 months. So if I take that piece from the unadjusted trial balance, oops, I forgot to remember that. 24 months or 24,000, sorry, is for 18 months. And so if I take that ratio, I get the amount per month. And if I multiply that, how many months do I want to record during 2020?
Is it 12?
Yeah. So always remember we're talking about the accounting period. Um, if the company is always making adjusting and closing entries once a year, then that means this was adjusted at the end of the prior year for the amount of time that had expired. This is now 18 months, but we need to just adjust since it was adjusted at the end of the prior year, then we're just worried about January 1st, 2020 to December 31st, 2020. And so when you look at it that way, you can see why you just can't take 12 December and subtract 1 from it, January, because then you'll come up with 11 months. And so really this is obviously 12 months when we write it out, and we really can see how that's working. And then so I take, the 1,333 multiplied by 12 months, and that gives me 16,000. So that's the amount to record during 2020. How am I going to record that? What do I have to debit? What do I have to credit? So first, let's start with the debit account. What do I have to debit?
Insurance expense.
Excellent. And what's my credit going to be to?
Prepaid insurance.
Excellent. And again, make sure you're giving yourself just a bit of a narrative behind it to make it better, more engaging into your brain. Hey, I'm using up prepaid insurance. Like way back, if it this is not the adjusted entry, but like I've mentioned in the video, sometimes it helps to do the original entry when I paid for this entire thing under GAAP accounting. I would have to have a prepaid insurance contract for the full amount when I made my cash payment for that full amount. And again, we're kind of running into that same situation with the building. I spent cash, but I have not yet recorded an expense because I want, by the expense recognition, I want to record the expense when it's actually being used up to create revenue. So I need to record some usage of this prepaid asset during 2020 as an expense, and that's how I want to do it. Expenses reduce net income. And if I credit the prepaid insurance, it's an asset, so it'll reduce assets. Good. That's not actually, I think I changed that one a bit. Not as bad as it was when I first did it. All right. So, here's another note payable. And we already looked at an interest one. Um, do, 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 do. This guy, deferred revenue. If these are gift cards and it says, hey, the deferred revenue account represents gift cards, um, why is it that a gift card would be considered deferred revenue?
Have they been used yet?
Right. If it's a good question, right? So let's say they haven't been used yet. When, or let's say they are considered deferred revenue when they haven't been used. What is it that why am deferred means I haven't done it yet. I've deferred on it, right? So why have I not recorded revenue yet? Is maybe even a better way of saying this.
Because they haven't been used.
Right? Okay, thanks, Gracie. But what is it about them being used? Revenue recognition says I should record a revenue when what?
When it's been used.
When you do the service.
Okay, that's exactly right. When I provide the service, yeah, which is coincides when they're being used. But yeah, that's what I was fishing for. Um, and I'm laughing at myself because of of how I can clumsily fish sometimes when I provided the service, the good or service. So correct. But now, if they're actually being redeemed, what does that mean? I can do what?
Spend them?
What's that?
Spend them?
Spend them. Well, so the customers are, quote unquote, spending them by redeeming them to the
Oh,
company.
you can
Yeah.
show revenue.
Right, exactly. Good. Revenue. So I'm going to credit revenue, and that I'm going to credit revenue for the amount that were redeemed. What's my debit to?
Deferred.
Yeah, exactly. Deferred revenue comes down. So we're earning the revenue over this year, right? And we're able to record revenue because of that. We're almost done with the entire problem, so why not just do this interest one? We've looked at an interest one before. We know that we want to record the interest
Well,
from.
hold on, pause.
Oh, sorry. I'm sorry. Yeah, what's up? Oh,
What accounts do that affects?
thank you. I almost left that off. So, deferred revenue. What type of an account is deferred revenue?
Uh,
A
credit
liability?
account. Oh, it's
Uh-huh.
a yeah,
And since we're debiting it, what's it do?
decrease.
Yeah. And revenue,
Check. Net income.
net income, up or down?
Oh, it's increase.
Yep. Good. Oops. Moved right. Cool. Yeah, that's all. You have to really look at there. So this guy, we want to record interest from September 1st to December 31st. Um, we're accruing this interest, right? We're not going to actually pay the interest until August 30th of the next year when after we have full years accrued. But we have to report at December 31st, so we have to provide this amount. How many months is that?
4.
Yeah. Good. And if we're looking for 4 months, we know that this is based on the note payable. So I go up to the up here, grab my note payable amount. Oh my gosh, there it is. Okay. 200,000. We always just record principal in this. So this is always just at the final amount we're going to have to pay the note off at. The interest goes into this separately recorded. So it helps us just determine this every period. Remember, the percent is annual unless otherwise stated. And so that tells me that I'm going to generate $8,000 of interest per year. But I'm only looking for 4 months. So I take the 8,000, divide that by 12 to get the per month amount of interest. And then I can multiply that by the 4 in order to get the amount that this is at. So this gives me um, a number that I'll round at the cent, and then I multiply that by 4, and I get 2,667 if I round to the nearest dollar. If ever you round something, just, the most to round it by is to the nearest dollar. Um, Otherwise, yeah, dollars are fine. Just be careful about rounding. Don't round to like tens of dollars or hundreds of dollars or thousands. That's bad. Bad. And so I record, what are the two accounts I want to record here? You saw this one. Debit to,
Notes payable.
oop, no. So remember, we only want notes payable to have the principal. And that is something I do see a lot. Like it's a common mistake in this one is people will include note payable as a debit or a credit in this. What's the payable account that, or first, I always want to go for like, what's the expense or revenue here? So we have,
Interest.
yeah,
Interest.
interest, right? We have that interest. And
Um,
then immediately, because you'll see this is kind of a common pattern in these adjusting entries, that if I'm debiting an expense, I'm usually crediting if it's a liability, the same name as a
Interest
payable
payable.
account. Yeah.
Okay.
Like there's, of course there are exceptions like depreciation expense. We're not crediting depreciation payable, but debit wage expense, credit wages payable is one, interest is one. I'm sure I'm forgetting another one that's pretty commonly used, but so I wanted to go back and do that one so that we could do the tax entry together. And because like I said, your tests will be a lot like example two, except it'll won't require to make 4 adjustments. It'll maybe like 2 or 3 adjustments at
So
most.
on that last one,
Oh, yeah,
the
sure.
accounts that it affects is what?
Oh, yeah, you keep catching me on that. Sorry. So the expense we know now is reducing net income, and the payable is what?
Liability.
Right, liability. Anytime, and I'm talking 100 out of 100, if you see the word payable, it's a liability account. Liabilities increase. Um, so yeah, with the like I said, you will definitely get something that looks like this with fewer accounts, fewer adjustments to make. And I'll kind of randomly select some adjustments to feature, but one adjustment that you definitely I can telegraph you is you will have to do a tax adjustment. So when we do the tax adjustment, we first want to get all of the income accounts from the adjusted trial balance. And because income accounts have a very specific place on the trial balance, they're easy to locate. They start after retained earnings and they do not include dividends. So these are my two income accounts that are on the unadjusted trial balance. I'm just going to copy them and bring them down so I don't have to keep scrolling up and down. And then we had all of these expenses we recognized that will hit the adjusted trial balance. So we had the depreciation expense. We had this insurance expense. We had this guy here. And then we had a revenue. That one's not as easy for me to grab. Like, oh, I was grabbing the others. All right. So we're assuming a 40% tax rate. I'm just going to, I can section break this. Some guy in IT, I was fumbling in front of me. He's like, you can just insert a section break, which I'm fumbling for. And, screw, maybe it's under layout. Yeah, break, page break, boom. All right. And I was like, yes, 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 I know I can do that, but I just don't. Anyway, so we have these and we have these additional adjusted pieces. And I'm just going to label them for you guys. Get them a little bit bigger too. It's not that big. All right. So we have expenses and we have revenues. And all we're doing with this information is calculating what our total revenues are. And in this case, we have 425,000. That was from the unadjusted. We're adding in 20,000 because we adjusted for 20,000 revenue. And so our total revenues then are 445,000. Our total expenses, just the same idea, 200,000 for that are unadjusted. And we're adding in the ones we adjusted for, so that comes out to 38,667. Sorry, that should say adjusted revenue. So if this is my total expenses and that's my total revenues, and these are both prior to tax, then I want to take their difference and I end up with 206,333. This is pre-tax income. Because what it tells me is this is the total income I have without considering taxes, just based on my revenues minus my expenses. Excuse me. Now, if that's my, sorry, go ahead.
How did you come up with the 38,667 for adjusted expenses?
These three. Oh, I added the wrong. Oh, sorry. Thank you for questioning that. I added, I accidentally treated revenue like it was an expense. I should have taken those three. And so that is 68,667. So that becomes 268. And 176,333. That look better? Sorry. Anyone have questions about that? I added these three and for expenses when clearly as labeled, I should have added those three. So then I just want to apply the tax rate, which the problem gave me as 40%. So I'm going to multiply 40%. It's going to, nope, it didn't this time. And that gives me 70,533 if I round. And since I applied the tax rate to pre-tax income, that's my tax expense. So that's how I calculate the number. But if I'm recording tax expense, think of it as any other adjusting entry. If I want to recognize tax expense, oops, then I would debit tax expense because that's how we create expenses. And what do I want to credit? What's the typical pattern for my adjusting entries?
Tax payable.
Correct. And since this is an expense, what's it going to do? What's it going to affect?
Net income.
Net income, correct. And it's going to reduce net income. And sorry for my caps lock shouting here. What and then the payable is what?
Liability
Yep, and that will.
increase.
Yeah. All right. Good, good, good. So that is the adjusting entry. That would be my answer.
So for the tax, for the
Mhm.
percentage, the tax percent rate, this is what we have to do, like to show our work,
Correct, right.
show
So
the
if
income.
yeah, that's the best way to
Okay.
share it. And also just, one thing, like I combined a bunch,
Mhm.
but you might, instead of doing what I did here, like just show them all together, or you know what I mean, like just so I can see each one that you're adding and subtracting. That way, if you just leave one off by accident, then I'm like, oh, minus 0.25 points because you forgot one thing, right?
Okay.
But yeah, if you like kind of went through it and did this entire thing, added and subtracted appropriately and got that, that might be better than doing, I mean, like this one stands on its own because it only had two parts. The problem here is I combined three. And so if you forgot to combine one, I might not understand what your total expenses were. I certainly wouldn't, after did that, it would be hard to track. Because the easier you make it to give you points, the more likely I want to give you points. It's just human condition. Not that I'm trying to mess anybody up, but if you show me every single little piece, then I'm like, okay, I can go through this and really figure out how many points this person has earned. So that's all the adjusting entries. Now, when we do the closing, all we have to remember, I should say, is okay, we're going to close. Basically, when we're closing, we're looking at just retained earnings and down. And so again, I'm going to replicate that down here for the closing entries. But remember, this is all on the unadjusted balance. And if we're closing, we would have updated all of these additional expenses would have gone in. I mean, not only would the expenses have gone in, but we would have debited and credited this liability account, etc. All we really need, though, is to consider what expenses and revenues we recognized, because those are the ones that I have to get rid of, in addition to the ones that are already on that statement. So basically, yeah, no, it's bad. Sorry. Doo, doo. There we go. That's what I wanted to do more so. So these got added to our trial balance. Now, when I'm closing out accounts, what do I need to close? Or I should say, when I'm doing the closing process, I tell you to of it as calculating net income and calculating retained earnings. So to calculate net income, I'm going to close certain accounts. What accounts do I want to close if we're talking net income?
Your expense and revenues.
Exactly. So my sales revenue is currently a credit, and this revenue should also be a credit, not a debit amount. So how much revenue, or I'm sorry, not revenue, do I want to debit or credit revenues to close them?
Debit,
Yeah,
debit.
we want to close with debit. So we debit revenue for 425 because that's the amount that was unadjusted. We did some additional revenue. You could combine these two if you wanted to. And what am I going to credit when I debit those revenue accounts?
The close summary or uh,
Yeah, summary, income summary.
summary, income summary. Yeah.
Yeah, I'm not too picky with the name, but but that is the correct one.
Yeah.
Then I need to do my expense accounts as well. Since those are at debit balances, what do I need to do to close them?
Credit them.
Yeah, credit them all. So my wage expense. And again, this is something I would do separately because just to make sure if you miss one of them, then it's just like half a point at most, right? Not much. I'm running out of room there. So insurance expense. And I also had what else? Other expense, depreciation I got, insurance, interest. And I don't want to forget, I had one other one that I created. What's still missing from my expenses here?
Your tax.
Exactly. Don't forget the tax one. It's easy to forget. So I'm going to debit all the, credit all those, and I want to do just the opposite that I did with the revenue. So I want to debit the income summary for that full effect. So I'm going to go through there, grab these 50, 16, 2.667, 50. This was 16. So it was 2,667. Wage expense was 200. Tax expense was like 75,333. I'm going to check that one. 70,333. 75,333. There we go. And then we add all of those up. That will be, I'm going to do a shortcut here. 268,667 plus 339,200. All right, so I got these together. So this is essentially calculating net income. And why is it calculating net income? It's calculating net income through the income summary. So I'm going to just use, this is how I create T accounts in Word. It's kind of ham-fisted, but it works. Um, I'm calculating, no, that's not what I wanted to do. I'm calculating net income through closing everything to the income summary. I mean, you can kind of, if you're kind of playing it fast and loose, but you could just call this account net income, quite honestly, because that's what its balance truly becomes. Because this income summary account is the most temporary of temporary accounts. It always starts with a $0 balance, just like absolutely all income statement accounts do. They always start at a $0 balance because they're always getting closed out. We credited this account for $445,000. We debited this account for $339,200. And when we reconcile this account's balance after we've made those entries, we see that the difference between those, I'll do that real quick, is 105,800. That's net income because all it was is our total revenues and our total expenses, including tax expense. So it's not even just pre-tax income. Net income is after tax expense has been considered. Now that I have this calculated as my net income, I want to turn to calculating retained earnings. What's my first step in terms of the entry?
Are you going to close it to retained earnings, like debit income summary and then credit retained earnings?
Exactly. So I'm just going to zero this guy out just like I would zero anyone out. Like I zeroed my revenues and expenses. I'd have to debit it by that amount. Income summary, 105,800 debited. Um, and then, as you said, Crystal, then this goes straight into retained earnings. So, and just as a word of caution, this isn't always a debit to the income summary. It it is if we made profit, if our net income was positive. But if our income's negative, then, for example, 445 and 339 switch places, then we have a loss on our hands. And it wouldn't be a credit balance anymore. It would now be a debit balance, which would be a net loss. And then in order to close this out, we'd have to credit income summary and it would debit retained earnings. But that makes sense because losses reduce retained earnings and would be debited to them. Here, we had the opposite situation and we had income. Well, that should be credited to retained earnings because net income, positive income, increases retained earnings. So now that we got that affect retained earnings, what's the other account that affects retained earnings besides our income?
Is
What's
it
up?
dividend?
Yeah, it's the one that we haven't used yet when I, pulled out 40,000. So we wanted, since dividends is a debit balance, we want to do what to them?
Credit.
Yep. Credit dividends for 40,000. And we debit retained earnings for that amount as well. And those are your closing entries. What I would do for the test, if you haven't worked through example three, then I would work example three because it's exactly like what we just did in example two. Um, it's a yearly adjustment. It does ask the same things of you. One thing you don't have to worry about that I don't put on the test anymore is whether it's a deferral or an accrual. They're just different types of adjusting entries, but I don't test over that like I used to. Example five is similar, except it's a quarter of an accounting period, so 3 months, not a full year. And yeah, those are good ones to do. Any small questions? Kind of over time now, but I can entertain like a small little question about something.
Not on this, but like maybe I know you're gonna hold this again tomorrow. Tomorrow, do you think you can go over the effects on the asset, liability, the net income, um,
Uh,
the you know how you
yeah.
did that on Wednesday?
Oh,
If you
You're
can
talking,
the
go
you're
the which
talking
one?
about these?
That
Yeah,
oh
yeah. Okay,
that
yeah.
that
I'll go
I
over,
don't know
yeah.
why those get me, you know.
Yeah. Yeah. Well,
So
I'm glad you had the adjusting entry part down. Like, the one I just did will be worth more points on the test ultimately. But yeah,
okay,
this will also be featured. So make sure, yeah.
okay.
I will definitely, is there one in particular? Like I can take if will you be able to attend tomorrow?
Yes, I will be.
Okay, okay. Well, yeah,
Yeah.
then pick your favorite one, or maybe I should say your least favorite one. And then
Okay.
I will definitely kind of cue that up as my first one because yeah, the this I will also put one like this on the exam, so
Okay.
good thing over. All right,
Okay.
cool. All
Hmm.
right, well, yeah, see you guys then at tomorrow. I'm gonna do the intermediate at 7 o'clock, I believe I said.
Okay. Yeah,
Okay,
that
good.
works
I just want
perfect.
to confirm that because I'm doing one for advanced too, and I was like, I forgot if it's 7 or 8, but yeah, cool. All right, well, hope to see you guys again. Hope this was helpful, and y'all have a great night.
Thank
Thank
you. You too.
Mhm.
Bye.
Y'all have a good one.
you
You
too.
too.